Thanks, Tony. Good morning, everyone. Thanks for having me back for the third time. I feel like I need to get you a card next week during Valentine's Day if we keep doing this. Forgive me if I don't. So for those of you that haven't heard me before, I'm the Chief Global Strategist for Pravasi Capital Partners. So some of you know I switched firms last year. I went from Invesco's chief strategist, a behemoth $800 billion company that's public, to a private company that was designed to help advisors build better portfolios for their clients by giving them access to content, and that's myself, information, and access to specialized managers that can make money in down markets. So it's a different challenge. It's exciting, but I'm still trying to do what I've always done, and that is figure out where investors have the highest probability of making the most money with the least amount of risk. And that involves following the economy. And I assume that you're here this morning to kind of get a sense of maybe what the outlook will be for you this year. But I've got to tie in both economics as well as investing, because that's where I spend all my time, and maybe you have an interest in that area as well. That's why we work, right? To live a better life, and you can spend what you make, and you can get your money working harder for you, or you can get paid for your brain power. But that's really about the only three ways you can build wealth, if you think about it. So yes, it's been challenging, to say the least. And the challenge that I notice is there's a lot of misinformation out there. If you're listening to the news programs to get a sense of what's happening, it's scary, because if you don't know the weakness of an argument, you don't know what you don't know, if that makes any sense. And there is a lot of misinformation. For instance, in August and even the beginning of this year, you heard that the markets were falling because of the slowdown in China. China's been slowing for 5 years. And no, they're not growing at 14% like they did in 2007, but they're not growing at 5% either. But if they were growing at 5%, they are contributing more to global GDP than they did when they were growing at 14%. Because they're 3 times bigger today than they were in 07. But you don't get that sense, oh, China's slowing. So how does that impact the U.S.? The correlation between China's GDP and the U.S. GDP is 0.16. We don't do enough business with China for them to matter. The exports in the U.S., as you'll see, is about 12%, 13% of GDP. And exports to China is about 1/10 of that. Just not big enough. But that's not what you hear. And you hear it from multiple people. And you have to wonder which side of the trade are they on. Some of those prognosticators, some of those icons in business might be short the market, and they're trying to get you to sell. They're trying to get the emotions built up, because that's how they'll make money. Remember how you used to watch some of these news programs, they'd ask the manager, well, do you own that stock? But you don't hear that from strategists. Are you short the market? Is that why you're talking it down? It's not the only reason, but it's just, the point is there's a lot of misinformation. So I guess I want to make sure that see if we're on the same page. And I'm going to start from an investment standpoint and then get into the economy, because it might give you a sense of how and why investing's been so frustrating for you. It's been difficult to build wealth in the markets, and a lot of that is how we're trained. I mean, this to me is a scary slide, in that with all the information, this is the average investor, retail investor, people that, as opposed to institutions. Last 20 years, the average investor has made 3.7% a year. About the only investment that did worse than that was Japan. How does that happen? What's created that? And what I notice in the 20-plus years that I've been working with advisors and their clients is amazing how many people make investment decisions based on what happened yesterday. Looking, well, gee, that hasn't done very well. No, but maybe it'll do well in the future if the future is going to be different than it was in the past. We make emotional decisions. Investors are doing that today. They're just selling because, well, the markets are going down. Okay, well, is it legitimate? All right, now every market in the world is priced for a bear market. And the U.S. is, except for the U.S., and it's pretty close. And bear markets, most of the time in the U.S., are born out of recession. So the discussion today will be, are we going into a recession? And I'll let you answer that as well, and answer any questions you might have. But that's criminal with all the information, because it doesn't have to be that low. But it really means trying to remove emotion from the decision-making process. And getting away from some of the, I guess, wisdom. I say that loosely, and you'll get my meaning in a second. But in our business, we've heard, well, it's not timing the market, it's time in the market. There's a lot of news. You've seen the commercial. The daughter asked the husband, well, does your broker give back the money if you lose money? And we're seeing a lot of people going into index funds and robo-advisors where if it was that easy, it's not that easy. Oh, let's just buy an index. Why would you buy an index right now when half the companies are hurt by the strong dollar? Dollar's been strengthening for a couple of years. So half your companies are getting hurt while the other half are doing well. They cancel each other out. Why would you buy an index in that environment? That's not the right structure. There are times you can buy an index where it makes sense, just not today. This is a stock picking market. So your returns will be challenged by thinking you can just buy it, hold it, forget it. And that's what John Bogle would want you to do at Vanguard. Buy it and forget it and just hang on to it. And yet there have been periods, 12 years, 14 years, 20 years, where the market trades sideways. Not always the best course of action. And I know why. Because most investors, we look at two things, returns and fees. And yet there's very little relationship between fees and performance. The fact of the matter is, technology is driving fees in almost everybody's business down. Everybody's charging about the same price. But let's see if you would agree with this. Strong economy, strong market. Would you agree with that? If the economy's doing well, the stock market should do well. Well, the correlation between economic growth and stock market performance is 0.05. There is no relationship long term. Oh, there are times when the market will react to economic growth, but long term, it's not important because it's only one of the drivers of the market. Would you say that earnings matter to whether the stock market goes higher or lower? Yeah. I mean, you hear about it all the time. And yet the correlation is only 0.19. Very little relationship between earnings and stock market performance. And yet there are times when it's very sensitive, but just not over a long period of time. In other words, most of us have been trained wrong on how to invest and what to look at because the market's really about expectations. That's what we're dealing with today. Will we indeed fall into a recession this year or next? Which would certainly impact your business, most likely. Because that's what the market's priced for. Markets go up when they get surprised, and they go down when they get disappointed. So if you can calculate what the market is pricing, not what I think, not what analysts think, it's called the implied earnings growth rate, the implied GDP growth rate. There's mathematical ways to calculate what the market's pricing and then determine whether you think it's going to surprise or disappoint. I wouldn't expect you to do that calculation, but there are people in my industry like myself and others that are available to advisors at big firms and small firms that do that kind of calculation. That's why it's been so hard, because you look at, well, earnings aren't going well. If earnings right now are coming down, if the market's only pricing in no earnings growth and earnings grow at 2%, then it gets surprised to the upside and tends to go higher. And earnings have been coming down, but mostly because of what? The decline in energy prices and mining. Those two sectors, earnings are up about 5%. That's why it's becoming a stock picker's market, because a segment of that market is dragging the total market down, in my opinion. Do valuations matter? And the reality of it is the correlation is zero under all time frames. And yet we talk about it, you hear about it on the news shows all the time. Oh, the market's expensive. Yes, but is it too expensive? The only time the market tends to struggle is when the forward price earnings ratio gets above 17. So if you're a layperson investor, that would be one number I would keep in your mind. And where was it? December? It was over 17. Where was it in August, right before the correction? 17.3. That was the forward earnings. So we know that over time, other than the tech boom, boy, if it gets over 17, it's hard for the market to go much higher than that. Where is it today? About 15.2, 15.3. The fact of the matter is, we have yet to have a recession when nominal GDP, the overall growth rate in the economy, is higher than the rate of 10-year treasuries. And right now, 10-year treasuries are about 1.75, and the overall growth rate in the economy is just under 3%, 2.9, as of the fourth quarter. Never had a recession when the growth rate is higher than the 10-year yield. So when I hear others forecast a recession, is that a high probability outlook or a low probability? Because I'm in the business of making decisions based on probabilities. That's a low probability outcome. They may be right, but they're not right based, that's more of a guesstimate than it is anything else. That's, hey, let me make the news by being outlandish right now. Because we just haven't seen that. Economy is driven by four forces. Yours, ours, everybody's. Government spending, corporate spending, consumer spending, overseas demand. Tell me how we're going to go in recession. This is an election year, correct? Do governments spend more money or less money during election years? They spend more money. We're seeing it at the federal level. We're seeing it at the state and local level, especially state and local governments because they've been improving their balance sheets. Their revenues have been rising. They went through a couple of years of austerity. They improved their balance sheets, and now they can go back and start spending and hiring more people, paying more money, having more projects. So that should be a plus for the economy. How about corporations? If you've noticed the productivity was negative, unit labor wage rates are rising, are companies going to spend more or less money on their businesses? Well, it tends to be a function of earnings, and if earnings are coming down, maybe they do spend a little bit less. But most of the less has been in the energy sector. The rest of the industry is doing pretty well. But let's say that's a wash, that the government, increase in government spending reduces the decline in corporate spending, but it really doesn't matter because you can see who the driver is. It's you, the consumer. So yes, manufacturing in this country, for the most part, is in a mini recession because we have excess inventories that need to be worked down in a global environment that's slowing. And a good part of the growth in the last decade was the emergence of emerging markets. Hyper-growth by leveraging up their economies from their government spending dollars to magnify that growth, and now they're slowing because they overbuilt. They're going to go through a period of deleveraging that'll take another 5 years, whether it's Latin America, Asia, or Eastern Europe. And that process is just beginning. And so without the leverage, when I hear politicians say, well, we got to get back and grow at 3-4%, we can't do that unless we lever up our economy. And that's what caused the problem the first time in 07, 08, right? You went and refinanced your mortgage and you spent some money and you refinanced it again, you spent more money, you refinanced it the third time and spent more money, and then the price came down and then you went, oops, there's payback for borrowing beyond your means. So the problem with the economy in 07 was the consumer's balance sheets were over-levered, and what has the consumer done since then? Paid off those debts. Consumers, there's something called the financial obligation ratio that just looks at income coming in and all the bills going out, and right now that position, the consumer, is in the best position they've been in since 1981. So I'm having a problem with the recession call because I see a stronger consumer today than I have in years. We have more people working, 2.7 million jobs last year, net positive, and it wasn't low-paying jobs. You can measure whether it's just in the service industry or the healthcare industry. We're actually seeing more managerial, higher paying jobs, actually at 52%. Wasn't like that until last year. But we have 2.7 million more people full-time, making more money, working longer hours. But the real benefit, and all of you see it and feel it, is the decline in energy prices. Every penny decline at the gas pump puts $1.5 billion in consumers' pockets in a year. 1 penny is $1.5 billion. Now, the best way I can explain this, and I think I used this example last year, but it just shows you if you thought these things through, how valuable it would have been to take advantage of it from an investment standpoint. But I've had some work done on my house in Annapolis, Maryland over the last 10, 15 years, and my subcontractor had mentioned that his construction guys, live paycheck to paycheck. And I thought about that, where middle, lower class net worths really haven't increased in a decade, and all of a sudden, that person has an extra $40 in his pocket. I'll give you 3 guesses what he's going to spend it on. You'll get 2 of them right. Beer? Okay. You got beer, more beer? Okay. Now it's not $40, now it's $200. So we might be talking about renovating the man cave. But the whole thing is, let's say he has a family, he hasn't been on vacation for 5 years. Where's he going? Disney, theme parks. He wants to take the wife for a vacation. Where is he going? They leave out of Lauderdale. He's going on a cruise. His birthday's Saturday night. He loves steak. Is he going to Capitol Grill or is he going Outback? He wants to buy some things for the holidays or for Valentine's Day. Is he going to Saks Fifth Avenue or is he going to other stores, Penny's or Target or... See, what we're seeing is the middle and lower class incomes may not have gone up over the last decade, but their disposable income is rising because they have less going towards heating and fuel. How do you go into recession when consumers have more money in their pockets? And you say, well, they're not spending it. They're spending it differently. They are spending it on travel, going in restaurants. Are you finding it easier to get into Capitol Grill here in Lauderdale? They're packed. They're all packed. We're driving more miles. You're seeing that now. Car sales, over 18 million units. Okay, 17 now, but booming. And why not? With low interest rates, 5 years at 2%, I don't know what the rate is, but it's 7 years out. And when the average person's got a car that's 9 years old, and washers, there's a lot of pent-up demand. Are they buying the 6th flat-screen TV for the bathroom? No. That was 07, right? Where you just, gee, I refinanced, got another 50, where can we spend it? Those days are gone. It's smart, but there is that pent-up demand. So if you're wondering how your business is going to be, then you'd have to ask yourself, is Fort Lauderdale, Broward County, is this a heavy manufacturing area that's going to benefit from whether China slows or grows? No. This is tourism. It's service side. Service businesses are doing great. In fact, that's where you're seeing the inflation. You're not seeing inflation in the traditional businesses of manufacturing. Manufacturing, which we all quote the numbers on the news programs to determine, oh, the ISM manufacturing index is below 50, which means it's contracting, not expanding. And the markets all of a sudden get nervous. And well, why are we getting nervous about 12% of the economy? That's all manufacturing is, 12%. The service side of the economy is 88. What should we be focused on? The service, the ISM, so to measure the service industry, whether it's contracting or expanding, it's at 53 and change. It's still expanding, adding more jobs. You're going to see a 4.5% unemployment rate by the summer, easily. There's enough momentum on the job side, and we're going in recession. Why? Where are the excesses in the economy right now? Have companies just hired too many people? I don't think so. Yeah, inventory's got a little ahead of themselves. Okay, that'll be done by the first quarter, and then the second quarter, I think you'll find that the growth we'll get past that soft patch. Globally, we're already seeing it. So when I think about what could cause exports, the dollar's been weakening a little bit, which will give us a pricing advantage, allow us to sell more goods overseas. That's a plus, not a minus. We'll get into the real estate side of it in a second. So when I look at the key drivers I just don't see the big hit to the economy that takes us down. Slow growth, yes. Recession, no. So what's the stock market likely to do if it's priced for a recession? Oh, which, by the way, the stock market is mispriced a recession 20 times in the last 60 years. So it's not the first time it's overreacted to data. What if the market's right? I can tell you, if this is a bear market, markets fall 30% on average. If it is a bear market but we don't go into a recession, the market's only going down 19 on average. I just wrote about it in my commentary, which is sent out monthly to, I don't know, 40,000 advisors. You could get it if you wanted, but it just, that gives you some idea of what's the potential downside. Because this might be a case where, forget the economy, the market's the market and it's going to do what it's going to do. And it is nervous about earnings. It's nervous about pricing power. See, that's where the news agencies, they narrowed down the problem. At least they're in the right zip code. I think they just missed the mark a little bit. See, it's not China slowing that's a problem. It's that for the first time in 10 years, their currency is weakening. They devalued their currency in August. Surprised everybody. Came out of the blue. It was really a preemptive strike because they wanted to offset what they thought would be a September Fed rate hike in the U.S., and the Fed didn't raise in September. They waited until later on. But it was a preemptive move, but it surprised everybody. But the point is, their currency is weakening, and all that means to you and I is they are exporting deflation. What it means to you and I is it's going to be hard to raise prices unless you're in the service side of it. But if you're competing in the global marketplace, and they just lowered their price by devaluing their currency, it's going to be tough for you to raise your price, if not impossible, which puts earnings into question. I mean, if you want to know why the market's going down, it's very simple. Markets don't like uncertainty. And if you wonder whether there's any uncertainty, let me ask you a few questions. How many times is the Fed going to raise rates this year? I don't know. Where are interest rates going? Up or down? I don't know. Is Draghi in Europe going to continue adding more liquidity to the marketplace? And how is Germany going to fare assimilating the refugees they brought in the country? Is that going to cost Merkel her presidency? Is China going to have a hard landing? What's with the Zika virus now? How is that going to impact Latin America, Olympics in the U.S.? I mean, there are a lot of unknowns. The markets don't like unknowns. So as the data comes out, the market goes, oh, I've overreacted, and I think you'll see that the markets will do better than what we're seeing right now, obviously, because what do we know about investor sentiment right now? The AAII Bullish Sentiment Index, it's the lowest it's been in 11 years. Think about that for a second. Investors feel worse about today than they did in 08 and 09, the worst recession since the Great Depression. See, that seems like an overreaction to me. That seems like the perfect situation where people are too negative, and what happens when they get less negative? Markets go higher, not lower. So am I worried right now? Yeah, I'm a little worried because the market's giving me a different signal than I'm getting from the economy. So you've got to be cautious during this time. But if you ask me to take a position, I'd say I think the market's overreacting. I think we'll do okay this year, but probably after the second quarter, because I know what's driving the market. The market is actually moving, looking at high-yield corporate bonds, and high-yield corporate bonds are tracking oil prices, and oil prices are likely to bottom in the second quarter. Because right now, the energy agency is underestimating demand by 1 million barrels a day. So it'll be faster getting into equilibrium than what they're quoting. So then the question becomes, well, what do you do? Where do you go? When the Fed raises rates, quality stocks outperform. Large companies outperform small companies. And it's not just large, it's almost mega. The bigger the company, the higher the quality balance sheet, they're the best performers and are likely to continue to be. So if I was an investor, I'd want to sell the weaker sisters or the companies in the portfolio or the asset classes in the portfolio that don't have good balance sheets, that are more cyclical in nature, at least for a while, and I'd want to go big. Companies paying dividends, increasing dividends every year. Low debt equity ratios, because you can see where the market's nervous about the debt on corporate balance sheets. That's why the high yield corporate bond market is suffering the way it is. It's because of the deterioration of the balance sheets in energy and mining. But that's what normally happens at the tail end of a bull market. We're not if we are finished, then the good news is the minimum return the last year of a bull market is plus 11%, and the average 2-year return is over 40. Markets actually do really well at the end of a bear market, or the beginning of a bear market, the end of a bull market. I put this together about 15 years ago. It's probably the most powerful piece that I can share with you. I advise institutions on asset allocation. The fact of the matter is, if you want to improve your odds of making money, then understand that for the last 30-some plus years, asset class outperformance has had a very specific pattern. And that pattern is clockwise. When large value companies outperform, the next best performer is large growth, and then it goes small growth, and it goes small value, and goes back to large value. There's all these sophisticated asset allocation models out there. It doesn't have to be that difficult. I believe you should own all 4 boxes. In other words, you own different things. You don't play hopscotch with money. But if you could predict with 75% certainty what would be the best performing asset class, wouldn't you put more money in that spot? Wouldn't that make sense? Last year, in my comments, I recommended that you would overweight large cap growth. What was the best performing asset class last year? Large cap growth. There's not just a pattern of outperformance, there's a pattern of underperformance. Whatever quadrant's the best, the diagonal's the worst at the same time. So whenever large value is the best, the worst is small. Large growth is the best, the diagonal small value is the worst. So you buy all 4. You put more money in the in-style box, you put less money in the out-of-style box, you let the market tell you when to make the shift. What was the difference of been last year between the best and worst? 12 percentage points, 1,200 basis points. Huge difference. Last 5 years, what was the difference? Over 50%. If you would have capitalized on it. Stays there 1 to 5 years. You can see it here. Best performing asset class is green and the worst performer is blue, and you can see a gap between each one because there's this pattern. Not every year. 75, 70, what's that, 77% of the time? 76% of the time. It works. It's been working here, it's been working overseas. So as you work with either yourself or your advisor, it might pay to put together a portfolio that just makes adjustments when necessary. You let the market tell you when to make this shift. And if you're wondering, well, when's that? You read people like myself or somebody else who's saying, this is what you should overweight and underweight. But yes, from a business standpoint, should all of you as business owners have a pretty decent year depending on your business? Well, where are interest rates going? For those of you that want and need income, it's a tough market because right now 80% of the world has rates of 2% or less. And now we're going negative in Europe and negative in Japan. Which is another way of saying the government's saying, get your money out of bonds and buy equities. That's what Japan's trying to do. Because they know the average Japanese investor has 50% of their money in cash. And if they just took 20% of that and put it in the market, it would double their market. And they're saying, well, we could probably get that done in the next 5 years just by keeping interest rates negative, which they are on a 5-year and 10-year basis. So where are interest rates going in the U.S.? Are they going higher? As the Fed continues to raise rates? Are they really going higher? Because when I look at what drives the 10-year Treasury, which affects mortgage rates and car loans, I see a 94% correlation between the 10-year Treasury and the 10-year German Bund, which is their Treasury. In other words, we're in a global marketplace. How do our rates go up when Germans' rates are likely to stay down? And why are they going to stay down? Because their central bank is still adding liquidity to the marketplace. 94% correlation, and 10-year German bonds just went negative. We have a global savings glut. When the average Japanese investor has 50% of the money in cash, the average Chinese investor has 40% of their money in cash, and a lot of Americans have their money in cash, where's it going? Interest rates go up when demand surpasses supply. Yeah, the Fed may raise rates. Everybody thinks, well, the 2-year rate's going to go up. Why? Who's issuing 2-year paper? The government's not issuing more paper. Plenty of demand. Plenty of businesses and insurance companies and corporate pensions looking for short-term money. There's a shortage. In other words, I could see interest rates staying lower for longer until inflation starts to rear its head, and that's what the Fed's trying to do. Get unemployment at 4.5%, and we'll start to see some of those inflationary pressures. But interest rates this year, the same or lower. So how does that work for housing? Is that going to help housing? Yeah, especially when you look at 25 to 34 age group. They're starting to get jobs now, finally. Because they weren't for a while. That was the fastest growing group getting jobs was over 55 since 08. But now, so guess what's happening with family formation? I just experienced. My daughter just calls us Thursday and says, yeah, I got engaged. I'm like, of course, you got jobs. Finally. You love each other, you got a job, you get married. That's how it works, right? So I've got a demand for housing. So when I see the monthly housing data, new home sales fell. That's because there's no inventory. Is there a lot of inventory? You live here. There's just not a lot of homes that's live. So that's keeping prices high. I can tell you there's over a 90% correlation between housing starts and the NAHB Home Builders Index. And the Home Builders Index is close to its peak. It's off a little bit, but it's still at the height of the range since 08. And building permits are still growing. So I suspect construction will still be great in this area, and real estate will still continue to move higher, especially with rates staying low, and car sales will continue. So how do we go into a recession? When the consumer has more money, working longer hours, and has more disposable income. How does that throw us in recession? It doesn't. It just says slow growth for a while until we work off the inventories. So yeah, I think interest rates will help you, not hurt you. As far as the dollar, the fact of the matter is, and this is very specific for those of you that might be in that business, where you're affected by the dollar changes. What moves the dollar-euro exchange rate is the difference in yields between our 2-year Treasury and the 2-year generic euro rate. And that spread is widening. So yes, the dollar may be weakening in the short term because now the world is saying, well, it doesn't look like the Fed's going to keep raising. So if it's not going to keep raising, I already priced the N3 rate hikes, and if you only get one, they'll pull the dollar back a little bit in the short term. But I think you'll see that most of the move in the dollar is behind us. I still think it'll strengthen a little bit, 3 to 5% in the next year, except for against the emerging markets, Latin America currencies, the Brazilian real, big moves in emerging markets. But not enough to really hurt businesses. It's the speed of which the dollar moves that kind of makes it difficult for companies to hedge those pricing inequities. So the dollar, I doubt, will get in your way. It's about the world just finally growing again and getting rid of some of the excess capacity that's out there, and the world's kind of doing that right now. That's why we're kind of going through this slow patch. From an investment standpoint, my advice to advisors has been, those of you that, the fact of the matter is, it's not about the market going up, it's about portions of the market going up. It's becoming a stock picker's market. So if you're just buying, and this is an expression we use, long only, which means you're just buying and holding as opposed to shorting stocks, selling stocks, hoping the price falls, it's going to be difficult to build wealth or maintain wealth because we're in a market that's going to be more volatile. It's going to be more volatile because of something called the Dodd-Frank legislation that just took the old guard, deep-heeled, deep-pocket investment banking firm that would provide the liquidity in the marketplace. They've been replaced. They're out of the business for the most part of providing that function. And it's been replaced by what we call high-frequency traders and computer programs. We don't have the same liquidity. And what that's telling me and those of us in this business is we're going to see more volatility, and that's going to make you more nervous if you're not used to it. And the best way I can explain volatility is, I remember the first time I took a shuttle jumper, I hope this doesn't sound, from Denver to Eagle Vale. Loved to ski. And we hit an air pocket and fell 150 feet. Now, the first time that happened, there were some people screaming for the greater God. I mean, they were frightened, and quite frankly, I tried to act like I wasn't nervous, but I was nervous. I mean, we were free falling, and then we landed fine. The 10th time that happened, it was like, okay, we hit a free. It's going to be a more volatile road, but it doesn't mean that the markets won't ultimately go higher over time. I think we're in a long-term secular bull market, mainly because I've got a dividend yield in the market higher than bond rates. Where are people going to go? They might be leaving the market now. Where are they going with their money to earn a decent return? They're coming back when they're less nervous. But for fixed income, for people who are saying, I need more, I can't just have the traditional investments, there are a lot of different strategies out there. This is one of them. This is a dozen of them. So the bullseye there is the S&P 500. Fourth best bull market in history. Bullseye, average return, average risk, and everything north and left did better with less risk. All I'm saying is, have a conversation with your investment professional, or if you do it yourself, think about incorporating strategies that aren't based on the stock market returns or the bond market going higher or lower. That's what diversification is. So that's the message I'm sending with advisors, is that yes, I've got a market that's priced for recession, and right now I don't have any data, not one piece of data that says we're going in a recession. It just says slow growth. So that tells me, all right, this market might go lower. Absolutely. You can't, because I've got Chinese investors selling because they were making money on something called the carry trade. They would borrow money in the U.S. and buy higher yielding bonds in China, and as their currency appreciated, that would cost them less to pay off their debt. And well, now the currency's not appreciating. And I've got oil prices falling. Well, have you heard of sovereign wealth funds? These are excess reserves at countries the countries have this money and they buy stocks and bonds around the world. And the 7 largest oil producing countries have $4 trillion invested around the world. And they made a lot of money, invested a lot of money when oil prices were rising. Well, now that they're falling, what are they doing? They're not buying, they're selling. So if you're wondering, who's doing all this selling? Because we're not. Are you? Are you cashing in your chips right now? I hope not. They're doing the selling. So yes, to think that oil would throw us into a recession, it's not big enough. Oh, all these people are losing their jobs. Yes, we lost 131,000 jobs in the energy sector, and we added 2.5 million outside of it. But how about the banks? Banks have invested, their loan book has about 3 to 5% in the energy sector. In 2007, they had 30% in the housing industry. That was the exposure they had. The exposure is not there right now. It is in Europe a little bit more than it is here, and that's why the European banks are pulling back. And I think eventually investors will realize their exposure isn't as great as people think either. So there's a lot of new ways to make money. It's about learning how to do that and finding an advisor that you trust. And if you don't trust your advisor, get a different advisor. Money's too important. But it's important to get it to work harder for you. But as far as the economy in Broward County, U.S., we're going to grow about 2% as an economy. Revenues usually grow 1% above nominal GDP. Nominal GDP will be at 3. Revenues will grow at 4. Earnings will grow at 5. And here you'll probably do a little bit better because housing will still do well, tourism should still do well. And I appreciate your time. I hope it was what you expected, and if not, ask some questions. I certainly am opinionated enough to give you an answer. But thank you very much for your time. Any questions at all? Yes, sir.
Although I
Come.
think we all appreciate the glass half full scenario you've laid out this morning, how has the drop in the stock market affected the average person that's lost 15% or 16%?
So how has the average person been impacted by a loss in the stock market? The average person doesn't own stock. You know, it's really the upper end of the stratosphere, and it will affect spending. And there are ratios between every percent that their net worth declines, how that impacts spending the next 3 to 6 months. So we can calculate the impact on that. But for the average person, it's about, I've got an extra $100 a week because I'm not filling my tank up like I used to. Maybe they got cars are more efficient and gas mileage. Their homes are more efficient. So for the problem with the recovery since '08 was it was just the upper 10% that was doing all the spending. And you were like, well, how much can they spend? Well, now it's the other 90% with that pent-up demand. You're seeing it in home renovation. Look at Home Depot and places like that. Their earnings have been picking up because people are going, you know, we finally can, let's paint the house. You know, we're 5 years overdue. Right? Let's renovate. So we're seeing a lot of that, and that's got to, I would think in this area, what I know about, having come down here for years and having a mother in Stewart, I would think that would be great for this economy. But yeah, psychologically, it might affect their spending for a little bit until they realize the economy's still doing okay. I still got a job and got this money, and let's hurry up and buy it, and we can get free financing and free shipping and. Yeah, no, I think the consumer is going to keep us from going into recession because manufacturing is in one. Yes, sir, right here. If we don't.
Is on margin.
Yes.
As those sovereign wealth funds, and that's been kind of a quick change for them. They also own a lot of illiquid investments in hedge funds and real estate. Do you think in time that the sovereign wealth funds will become marginal sellers in those markets as we move through the next few years, or will they be able to get their act together and get oil prices back up to the levels where they don't have to be that marginal seller that they are now?
So the question is, sovereign wealth funds not only bought stocks, bonds, they bought a lot of other illiquid investments, sometimes on a leverage basis. My position is energy bottoms in the second quarter. So if I'm right on that, then we've got about another 90 days of pain, and then not. Then they'll go, okay, we don't have to sell. Let's hold on for a while. And you'll probably see the price fluctuate between 30 and 50. At 50, the shale producers, the frackers up in the North Dakotas, they'll start producing again. At 30, it doesn't work for anybody. I have the break-even monetary budgets, the break-even energy price for all the energy exporters. Kuwait's break-even was at $44, and we're at just around 30. Saudi Arabia, which has a 20% deficit to GDP, that cannot meet their social mandate, their break-even is almost $100. And what I mean by that is, what's your budget? What revenues do I need from energy to meet that budget? It's not $30 a barrel. And so there's a lot of pain. And I thought, and this is going to, I don't want this to come across, I thought part of the reason energy prices had fallen was it was a great way for the U.S. to punish the bad guys in the world. Russia, Iran, Venezuela. And the pain is there. And to a point where we need to take that leverage point off. That was my conversation with the Pentagon last year when they asked me to come in and talk to them about the world and how I see growth and the drivers of it. So I think you're going to find the best thing for energy prices is low energy prices. It's self-correcting, isn't it? It's not productive for the world right now at $30. And so you'll see a lot of drilling off the market. Historically, when oil and gas drilling declines more than 50% in a year, and it's down over 55, actually 60% now, oil prices rise 80% of the time. The following year, the average increase is 40%. So I suspect we'll be in this $30 to $50 range.
Yeah, related to that, I'm in the solar business, and nobody in the industry saw this extension, the 5-year extension of the 30% investment tax credit. But we were told that it was kind of a trade-off to export oil. They compromised on that. Do you have any other insight into how that got through?
I wish I did. I follow a lot of things. I don't follow all things. Other than I think you're going to find government more business friendly, and I expect the new administration to lower the corporate tax rate, and that will extend the bull market in equities for another 3 to 4 years, maybe 5. But it's difficult to expect companies to bring their foreign profits back home when you have the highest taxing country in the world. It just doesn't work. And if you want to create jobs, then make it easier for businesses to hire people. And so those are the two. So it's about becoming a little bit more business friendly is the easy answer.
With the silly season on and the election coming up, what's your opinion on what happens to the White House if we get a communist or a socialist versus any Republican?
So you're talking about Trump getting in the White House? Oh, yeah. Well, that's another one of those uncertainties, isn't it? Because whoever you're for right now, the thought of somebody else getting in has got to be frightening to you. I mean, if you're for a communist or socialist, to think that you're going to get maybe a dictator, so it's another uncertainty that just makes it more difficult to feel comfortable about investing your money. The way I handle those issues, and I'm not going to get into, well, I could get into politics, but I won't. There's a way for me to measure political risk now. It's called the Economic Policy Uncertainty Index. You can get it emailed to you monthly. It's designed by 2 professors from Stanford, one from the University of Chicago. And they measure that uncertainty, and it helps me as a strategist when knowing whether it's high or low, whether the market's complacent or if it's really scared to death. And I can tell you that index tracks investor sentiment, and it also tracks what the market's pricing for earnings. And when it's disconnected, I've been able to make some really great calls. For instance, when you and I got nervous in August and September of the correction, there was a disconnect between sentiment and earnings. And I wrote about it saying this market's either going down 10% or up 10%, and all of a sudden sentiment started to improve, and that's where we got the 10% rally, which is pretty normal. When we have the kind of correction we have right now, the average recovery is 10% at least. Election years usually has a positive stock market 80% of the time. That goes back to the 1900s. So you said half full. It's because at this point in time, the market really is right at its balancing point, whether we're either going to go lower, a lot lower, or we're through this and it'll start the recovery. And there are metrics that I'm tracking that will tell me when it's safe to go back in the water. And it's not safe yet. This market could easily continue to kind of build on itself. Right now, the bears are in control. And you see it in the news. You get positive news, the market just ignores it. All it wants to hear is negative, and I don't know, it seems to be like we just want to commiserate on how bad things are when they're really not that bad. Last question.
Hi. With the accelerating national debt, at what point does it become a threat to the economy? When you watch Greece on the news, it's pretty scary.
Yeah, I guess maybe I'm just not worried about the national debt. When you say accelerating, there's a calculation known as the second derivative. It measures the rate and the change in the rate of change. And it's actually not accelerating, it's decelerating. If you look at the deficit and how it's come down the last 3 or 4 years, it's been pretty remarkable. And that's because for the first time since the Korean War, the government's actually been spending less money 2 years in a row. They've actually been holding this economy down by about 1.5 percentage points. And now they're starting to, instead of being, you had the sequester, if you recall that, that was a drag on the economy. That's kind of behind us now. So revenues have come in, tax revenues have come into governments, and so they haven't been increasing their spending. So it's come down from 10% of GDP to like 2% of GDP. It's going to go back up again, just because some expiration of some things. But right now the deficit is very manageable. If you think about what part of our economy does it take to service that debt, it's very manageable. We're an $80 trillion net worth country with $2 trillion in debt. Not a lot. Not that much. Very manageable. That's one of those things I think that's a little hyped. Yes, sir.
You said it was a stock picking market. Will you be able to give us 3 stocks?
So can I give you 3 stocks today? That would be no. That's the only thing I can't. Sure. So I won't give you stocks, I'll give you areas. I think people are going to make money in energy this year at some point, but probably on the debt side instead of the equity side. I think the consumer is going to continue to do well. So I would look at where does the middle and lower income person, where are they going to continue to spend their money, and I would buy those things. I would look for the everyday things. For instance, I don't drink coffee, but my wife does, and so we've had 6 coffee makers in the last year, and all of a sudden I saw this one called Keurig, right? You all probably have them. Well, that stock went up 70% not too long ago because all of a sudden their earnings went up. I mean, the everyday things. But you got to love social media. You got to love technology for the consumer. So again, think of the middle, lower end. Time for a new phone. Time for a new device, a new something, a new gadget. Because that's part of your brand, right? You got to have the right stuff. So. You know, we're going to have 20-inch tablets now. They're getting bigger. But yeah, I still like the consumer side of the business. I still like technology. I still like healthcare, and I think they'll do well over time. Thank you very much for your time. Appreciate it.